So welcome to RealWealth's mid-year housing update. I'm Kathy Fettke, and I just put some slides together to help us all understand the very confusing headlines that we're all seeing, and hopefully make some sense of it. I do this every quarter, and very happy to be doing it here today. So my disclaimer is, don't sue me for my ideas. These are just my ideas. Use them to do your own due diligence, but at the end of the day, it's always up to you to do that and to seek advice from your CPA and your financial advisor and whoever that may be, your attorney also. Okay, so let's talk about scary headlines. I just typed in recession because of course we hear that all the time, and these are just some of the headlines I saw. Is the US economy headed towards a recession? Inflation remains a key factor. Recession fears loom. So if you are at a cocktail party, you're probably hearing talk about recession, and for good reason. And when interest rates increase, that is a possibility that we would face a recession. So it's the talk of the town, and we're going to discuss that here. You also see these kinds of headlines. This one says, keep an eye on those overvalued housing markets as the housing boom implodes. Now, if you were a busy person and didn't really have time to read the full article, I'm pretty sure this would freak you out. It would freak me out. But when you read the article, the imploding boom that they're talking about is that over the coming months, 12 months, CoreLogic forecasts US home prices will rise another 5.9%. So the headline ought to be that, right? That we should expect to see prices continue to rise. But instead, what made the headline is the imploding boom. And that's what has obviously a lot of people freaked out. So, and then you'll see tweets like this and conversations on the street and just talking to people. This is a tweet that said, according to Alto's research, real estate market data thread, let's just call it the pandemic real estate frenzy is over. Available inventories up by 5.7% this week to 364,000 single family homes. So this shouldn't scare you any more than, it should scare you in the sense of, wow, this is really bad for first-time home buyers. There is just not enough inventory out there. But the way it's stated, it sounds like there's too much, right? That we have an abundance of inventory, but when you look at the picture, it is still far, far below where it should be, and far, far below where it was in 2019 when no one was freaking out. So again, the story is the lack of inventory, and that's what we're going to talk about today, the reality of the housing market versus the headlines that are either meant to get your attention because fear always works. That's in my experience and having worked in newsrooms for years. Fear-based headlines attracted eyeballs, which helped us get advertisers. So at the end of the day, it's always about how many people will look and view what you're doing, because that's where the money's made from the advertising. So we've got to always look behind the headlines to find out what the real story is. So again, this is the real story. Inventory. Housing inventory is still way too low. And because of that, it is an incredibly unhealthy housing market, but not in the ways that you're seeing in the headlines. The unhealthiness is simply the lack of available property. And that means it's still a seller's market, which means the seller still has the power. Now, is it shifting slightly? Yeah, slightly. And by slightly, it's this little section right there. That's how it's shifting. So the seller still has the power in most markets. The buyer is just, dealing with the bits and pieces of inventory that's out there. Again, record low inventory. Lots of people are scared that we're heading to another crash like 2008. And if you were a part of that crash, you have every reason to be scared. Rich and I got totally wiped out from that. So I understand the fear. And for those who, again, don't really know how to look behind the headlines, which is most people, because it's confusing, You know, we might think that we're heading back there, but when you see this slide and see that in '07, when when the bubble burst back then, there was 3.7 million homes on the market. Today, 870,000. So very, very different scenario. We do not have an abundance of inventory. We're not flooded with inventory. We want to be, we need to be, we need to get back up to the average to have a healthy market, which would be a market where there's not multiple offers and and a lack of choice. When my daughter bought her house in December, there was literally 2 houses in the area for sale, and she fortunately got one of them, but there were hundreds of people that came to the open house and didn't get that home out of just the 2 that were available in her price range. So this is really nationwide. 14 million more households today than there were back then. Again, we can't compare today with 2007 and think it's the same. It's not. We have 14 million more households today than we did then. And let's go back to that former slide, but 3 million less homes available. Let me say that again, 3 million homes less available today and 14 million more households. This is the problem. This is why the housing market is unhealthy. And we do hear headlines about population growth slowing, and that can be scary because you need a growing population to have a growing economy. It's not necessarily good for everything to do with the world. If we're running out of water and we're running out of food and we're running out of space and so forth, population growth isn't necessarily a good thing, but it is good for an economy, and people get nervous when they see the headlines that the pace of growth is slowing. But when you look at overall population, thank goodness it's slowing. The world doesn't need that many more people. And so here we are with a growing population, but a percent change that's slowing. When you look at the US, we do have strong demographics compared to other places like Europe and Japan and China, where they don't have this younger generation to support the aging population. But we do. We have very healthy demographics, and right now maybe a little too healthy because that you can see, and I've shown this slide a lot, but obviously, we have an aging population, and as people age, they die. But there are ways to stay healthy and more healthy and live longer than there ever have been. So while the baby boomer population is declining simply due to death, it's also a really large population of 68 million people. But the big generation is these millennials, and the largest group of them, this is showing 2022, so we have to fast forward. They would be 23 to 40-year-olds. Which is a really big gap, right? I mean, it's a big group of people to compare a 23-year-old with a 40-year-old. They're in very different places, right? So what we don't want to, these people, these 23-year-olds are not home buyers. They are apartment people though, right? And over here in the 40s, well, they might already own homes, but maybe not. But what we're really focused on is this group here, which is the peak home buying age at this massive group of millennials that are just turning home buying age. And that is what we're seeing, this frenzy of people forming families, creating households, seeing rents going up, thinking, boy, I don't want to have to deal with that. I'd rather lock in a payment, even if it's a little bit higher, at least it's locked in and I'm not dealing with so much uncertainty. So it's this group, for years, there's been headlines blaming millennials for this and that. Right now, we really can blame millennials for this housing situation because they're buying, and there's a lot of them. So, and I'm just kidding. It's just that it's a large group, but it's not their fault that there's not enough inventory out there. This was an article that came out last September, so you hear all kinds of things about demand, but this particular one showed that we're 5 million homes short. I've seen other ones saying 1 million. there's no like real clear guidance here, but there is between 1 million and 5 million homes that are needed and that aren't there. So the question is, are we going to solve this problem quickly? Are we going to be able to bring in new supply to meet this massive household formation? When you look at the new home lot supply index, doesn't look so great, right? Not a lot of lots that are ready to be built. New subdivisions, is that going to help? When you look at this, it's not looking great on the new subdivisions. I've said this before, but RealWealth bought land in Tampa, 4,200 lots. The project is called the Murata. If you want to check that out, it's right outside of Tampa. We bought that in 2012 and syndicated it. Our business plan was just to entitle it and sell those lots, and we have been for the last few years, but it wasn't until the last few years that we could, because it took so long. It took nearly a decade to get those lots ready for sale. So it's not something that happens overnight by any means. You've got to get the utilities in and the roads and the permits. That's the hardest part. So on top of that, we've got new listings down. So I've shown this slide before, but boy, oh boy, this says a lot here. People aren't listing their homes, even though they can get top dollar for it. It's a seller's market. When you look at that orange line, which is 2021, it is a third, even a fourth of what the inventory used to be. Why are people not listing their homes? This is the kind of the new word that's being put out there. It's the lock-in effect. People are locked into historically low rates, in some cases 2% interest rates. Why sell your house and just so you can buy a more expensive house with a higher interest rate? So part of the reason we're not seeing a lot of new inventory is who's going to do that? You're locked into such a low payment. Even if you did have to move, you might just keep that house and rent it out. Here's a slide, very hard to read. I apologize, but I wanted to put it on here, and you can zoom in and watch it later. But these are the most undersupplied markets. Atlanta, New York, you can see on there, San Antonio. Some of these areas, it's just hard to get new supply like New York. Dallas, Boise, Austin, Denver, Minneapolis, Sacramento, you see the list. These are the areas that's just hard to bring on new supply. And add to it the supply chain issues from the pandemic. We've seen the ports in Shanghai just shut down due to their COVID outbreak or re-outbreak. And then of course this awful war in Ukraine. So will the supply shortages go away? We're not really seeing that yet in the construction industry. And again, RealWealth has syndicated 6 different single family home subdivisions over the past decade. So we are experiencing this as well. In fact, and we work with so many builders who sell new homes to our members as rental properties. And this is the kind of thing they're experiencing. This is from Zonda. They did basically a survey of the builders that they work with. And this is not something I've ever seen in the past, that you couldn't get your home complete because you can't get garage doors. Look at that, nearly 40% of the builders that were interviewed and surveyed said this is a serious shortage. And many municipalities won't let you close and get your C of O until you have these things. Windows, probably need windows on your house in order to get the CO. HVAC equipment. I mean, again, we haven't been here. Trusses is a huge one for our Florida team. They cannot get them, and you need them to build your house. So this is, again, is the supply issue going to be solved? Not anytime soon. So here's the household formation versus the supply of single family and multifamily housing. I'm sorry, at least completions. And that jagged line is household formations. So you can see in the past decade where household formations were much, much bigger than the new supply. And then of course in 2020, people went back and lived with each other. Kids came home from college and people came home to stay at home together, right? But then it picked right back up again to where it was before, and just massive household formation and not the supply to keep up with it. As a result, we see U.S. apartment vacancy rate at the lowest it's been in a long time. I mean, that slide is incredible in all classes, Class A, B, and C. Just vacancy rates very low. And where? What does it, obviously, we're not a national, there's not one housing market. There's a whole lot of markets in our country. We have a very big country, but you can see that the migration is still heavy in the Southeast and Southwest. The blue is the growth, where the migration is going, and again, it's pretty obvious where it's going. As a result, rents have gone up. When you have this much household formation, you've got home prices up and mortgage rates up. So more and more people renting, more and more people fighting over that rental. Look at that, rents up in Orlando. This is crazy. This is not healthy. It's not good for a family. It's just trying to get by and dealing with inflation and everything. So when we need to see more inventory on the market. Unfortunately, when you see that in a headline, it's framed as a bad thing, when actually it's a very, very good and important thing that we see an increase in inventory to slow down this insane rental increase. And a home price growth as well, with double-digit increases in 70% of 185 metro areas in the first quarter of this year. Over 34% in Tampa in home price growth, over 30% in Dallas. Again, not sustainable, not healthy. Pretty cool if you own property there. Anyone who's owned property is sitting on a whole lot of equity. Very, very hard for people trying to get in. And also another reason for the lock-in, you're just not going to walk away from all that equity. Unemployment has almost completely recovered. It's phenomenal to think that here we are 2 years later, a little over 2 years from such a unprecedented, life-changing event worldwide, and to see that we had 22 million layoffs, people out of work so suddenly, and then back to work so suddenly. It's incredible. And just again, amazing to watch. In fact, who would have thought that we would have too many job openings just 2 years later? Who would have predicted that? I mean, I know some people who did. And fortunately, I get to interview them on the RealWealth show, which really helps us all stay informed and, again, read between the headlines when we get to interview these experts. But wow, I know Logan Mohtashami of Housing Wire predicted that we'd have a return of jobs by this time. So he was right. Too many jobs. Again, people thought maybe as interest rates go up that this would change, but we still had 11 million job openings in April, and that's about 2 jobs for every person who wants them. Unfortunately, that also creates more inflation because employers have to pay more and they're going to pass that on to the consumer. And then add the sanctions that we're seeing with this horrible Russian war, just absolutely horrible war, which is also affecting, most likely Europe going into a major, major recession. Very sad, as they try to do the right thing and get off of any Russian goods at all, including energy, which they so depend on. They're taking a huge hit in Europe by doing that. Doing the right thing, but it's going to be very hard on them. And then, of course, the food crisis that we're going to see on top of all the inflation that we're seeing worldwide. A shortage of food is going to keep food prices up and energy costs up. So how do you slow it down? That's what we keep seeing in the news, is the Federal Reserve is tasked with controlling inflation. They didn't do a great job. They did not do a great job. They kept interest rates so low for so long, way too long. It was very obvious that the housing market was just going crazy last year, and they didn't raise rates till this year. So it takes a lot of nerve to raise rates because it does slow things down. It slows down a booming economy. but they just took too long, and the overnight lending rate was at zero for just until this year, and the Fed raised just 1/4% beginning this year, and then another 50 basis points, I think, in March, and now I think it was March. So now we're at 0.75 to 1% on overnight lending rates, which is still way too low to slow down all this boomingness, right? So let's talk very quickly about the flow of money. I know many of you have heard me say this, but I'm just going to do it again for anybody who hasn't. That the money is really different today. It used to be that, go back many, many years and you'd trade a horse for a cow, or you'd trade a pie for, I don't know, some wheat, whatever. You'd trade stuff. And then it became easier to have something everybody wanted, like gold. So, wow, if you have gold, then you can have whatever you want. You just trade that. And then it became very dangerous to travel or have gold or silver or any of these things. So it got put in a safe place, basically a bank, and you got a little note saying you've got this much gold stored away, and that note would be passed around. But it was always secured to something of value. Now we know that that's not the case today, because in 1971 we were taken off the gold standard by Nixon, and it's just really up to the government and the Federal Reserve to decide the value of money. So it's really not worth anything at all except for what the government says it is, and they basically pull the levers to put more money in the system or less, and that's how booms and busts are created. So if you've got more money poured into the system, there's more money circulating, it increases the money supply, and that generally leads to inflation of things that are limited. So if you had lots and lots of money circulating, but you had lots and lots of things to buy, there wouldn't be as much of an impact as throwing trillions of dollars into a system where there's a very limited supply of things that people want. And that's what happened with housing. So I'll show you on the next slide. When you do the way that the Federal Reserve will curb inflation is decreasing that money supply and pulling money back out. And that usually happens by increasing the cost of capital and then selling off their assets. So that typically creates deflation. The thing is, they've got to do it in a way where it doesn't crash, or where it's a soft landing. And that's why people are nervous, wondering, will they keep raising rates till we run into a major recession? Again, it's the central banks who regulate that. And it's really important to understand that the Federal Reserve is the central bank system. It is not federal, and it doesn't have reserves. The Federal Reserve is a banking system, and it's private. Yet this private banking system has the ability to control so many things, the money supply, the cost of money, and inflation or deflation. So we've given a whole lot of power to the banking system. It's really important to understand that, because a lot of people think that it's the government. Of course, the government loves it because the government works closely with the central banks to be able to get money when they need it and want it. And that comes in the form of printing it, which the Federal Reserve can do, but the US government isn't really allowed to do. So they can have the banks do it, and then they borrow from the banks. So in the last 2 years, the money circulating through this M2 slide shows that there's $6 trillion more circulating today than there was 2 years ago. That's a lot. And it was even more than that just a few months ago, before the tightening started, before the Federal Reserve raised rates. So we still have $6 trillion circulating that wasn't there just 2 years ago. And when you look at that, I mean, that's a huge, huge part. If the amount of money circulating was just around 16 trillion, it's add 6 trillion, that's a huge percentage of money that was added into the system. And that happened, of course, on March 23rd of 2020, when the Federal Reserve basically announced that they were going to use the full range of tools to support the economy, which is a fancy way of saying they were going to flood the market with money. So in the past, you can see how the Federal Reserve has regulated interest rates, and that's the overnight lending rates. When you hear the headlines about it, it's not mortgage rates. It's the overnight, it's what banks borrow money for. So if banks can borrow money at 0% and lend it to you for, that's why they could lend it to you for 2 or 3%, because they make their little margin there. But now that it's at 1%, then rates should be really closer to 4%, honestly. So that's why I think that we're going to see rates going back, because banks can still borrow money for super cheap. They're just pricing in what they've been told, which is that the Fed is going to keep raising rates till it gets to 3, in which case we would be close to 6%. But will they do that? Let's see on the next slide. I put this in here because all of this is to say that fear creates opportunity, and the headlines that we're seeing may not really be reality, but if nobody else knows that, you get to enjoy a sweet ride. So let's say that we were surfing and there were some really good waves and there's 20 people out there. It's not as much fun as when you're the only one out there. So if I mean, a lot of surfers, and I use this metaphor because Rich and I do surf, and I actually did a surf camp in Costa Rica, and there was nobody at the place where we were surfing. I'm like, how is this possible? He said, oh, because I submitted a picture to the newspapers showing alligators and sharks here. And so nobody comes here. I'm like, well, are there alligators and sharks? He's like, they're everywhere, but we made sure it was really publicized that they're here, and that keeps people away. So that's kind of what we're seeing. Back in 2018, when I was on a lot of TV shows, because the Fed had raised interest rates at that time, and we were starting to see a slowdown in housing. I had to explain that it's a healthy slowdown. It's not a bubble bursting. It's what was needed at the time to slow things down. Right afterwards, a reversal happened, and rates went down again, and that stimulated the economy. But back then, rates were going up kind of to where they're supposed to go this time, and it did slow down housing. But again, it wasn't something to be so afraid of as welcoming, like, okay, this is going to really balance things out, hopefully. That's the only way that the Federal Reserve knows how to deal with inflation, is making fewer people able to buy, eliminating competition, which is what they're doing. So because rents have gone up so dramatically, and because home prices have gone up so dramatically, much in thanks to what the Federal Reserve did in keeping rates low for so long and flooding the market with so much capital, rates are kind of just back to where they were a couple of years ago, but it happened so quickly that it's just shocking the system. And people who got really used to that cheap money don't know what to do with normal money. So the rates that we're seeing today are pretty normal. So the question is, how high will rates go? And is that something we should be concerned about? Well, again, this is the overnight lending rate. Oh, no, this is the federal debt. Sorry, this is the federal debt. And those arrows are every time that the federal debt has doubled. So we are in a very different situation today than we were during the last recession, or the one before that, or the one before that, where if you had too much growth, you could raise interest rates, but they can't really do that today. It's a very different place. Again, a very different world that we're in today than we've ever been in before. We've never had this kind of debt. So how much can the Fed raise their overnight lending rate if they got to deal with this kind of debt? $30 trillion. We need to be able to at least pay the interest on that debt. I don't think anyone has any intention of paying off the principal, but the interest, that kind of has to be paid, or else you go into default. So how high can the Federal Reserve increase interest rates and have it not affect this? And the answer is it can't go much higher. So that's why I'm not in the camp of interest rates going up much more, the overnight lending or the mortgage rates. You'd have to, really believe that either they're okay with the government defaulting, or that we're going to have such a booming economy that rates will have to continue to rise. I don't see that. What I do see is this new world that we're in, modern monetary theory. This is something you should look up because this is the world that we're in. It's not the world of our parents or us when we were little or our grandparents. It may be for the reality of different countries where the only way you solve problems like debt problems and needing to build new infrastructure and fund wars and such is to simply print the money. And this is the new modern monetary theory. This is the way that you get things done, is you print more. And again, as you can see, so much we've really come to rely on the printing of money. Back in 2008, we thought we were printing a lot of money, and it dwarfs in comparison to where we are now. It's called modern monetary theory, and this is the M1, and it shows the amount of money circulating in just the last 2 years, and that is phenomenal. What we know is that inflation is not new. That ever since 1971, when we went off the gold standard that was basically keeping things in check, all of a sudden the government and the Federal Reserve could work together to continue printing money to solve problems. And that has resulted in inflation. So it's nothing new. What is new is how much money is being printed and how much inflation that might create. So that's really the environment that we're in, is inflation in things that are limited and that people want. Housing inflation, we know that the amount of housing out there is limited compared to demand. So that is part of the reason we've seen prices go up far beyond their last peak because of that massive demand. So is it a perfect storm for real estate investors, or is it uncharted territory and should we be afraid? This is the big question. Well, when you look at mortgage rates over the years, I know it's a shock to the system what happened so recently, but it had to. Rates had to go up fast to slow down this train, this housing train that won't stop. The appreciation, 50% increase in home prices in a year is terrible. It's terrible for families. So the idea was raise rates fast and slow that down. But when you look historically speaking, it's really kind of not that bad, right? It's still in line. I put this date of February of 1997 because that's when we got our first mortgage, and it was 7.6% at the time. And that was a good deal because, look at where it had been. So we were pretty stoked on that. So here we are today at a little over 5%. Mortgage rates have come down a little bit over the past few weeks. And based on the people I talked to, this is kind of where they're going to peak. Because again, for rates to go up more, you would have to think that we would have a very booming economy in the years to come. But what we know is the Federal Reserve is trying to slow down that boom by raising the overnight lending rates. So it doesn't make sense to think that mortgage rates would go up at a time when the economy is probably going to slow down. So I'm in the camp of we've hit the peak there and we're either going to hover around here or start to see rates go down. And the reason is when you look at some of the other opportunities that are out there for investors, you've got Japanese treasuries, not necessarily a great investment in my opinion. You got German treasuries, French, Germany and France are going into a recession. People are going to wonder where to put their money. We've seen the S&P kind of not doing so great. UK Treasury, Canadians a little better. But if you have money, where are you going to put it? This is CRE yield. That's commercial real estate in America. You might put it there, or you might put it in single-family housing, or you might put it in mortgage-backed securities in the U.S. That's better than some of these other options. So again, you'd have to see all of these other countries, including China, have just booming economies in order for us to have higher interest rates, because that would mean that we're trying to get more people to invest here, but they're probably going to be sending money over to the United States for investment, which then brings the yields down. Yields go up when they're trying to get people to invest. They go down when more and more people are investing. It's the flight to safety, basically. Okay, so how to navigate all of this? Again, I'll just tell our story. That's Rich and me a long time ago when we were so much younger. I look at this, I'm like, oh my gosh, amazing. What is that? Oh, 16 years? 16 years can do. Anyway, when we bought these homes in Dallas, we bought them in 2006, technically the peak of the housing market. So a lot of people are like, oh, I don't want to buy at the peak. But we did. We bought in Texas at the peak of that last housing cycle. And we bought a lot of these homes. They were around $140,000 to $150,000, and they rented for about $1,400 to $1,600 a month. It made total sense to us that we were willing to buy at the peak and sell anything in California to be able to exchange into this area that we knew was growing with job growth and population growth. And we didn't care that we were buying at the top of the market because we saw further growth in that market. And I think you can all agree that we were right. These houses are probably worth three times at least what we paid, and are in highly desirable areas. And we knew that because we knew that the job growth and population growth was heading there. So when the Great Recession hit, those homes really stayed rented and did very well. And the thousands of people that we helped do the same thing in Texas back then, they didn't feel the recession, at least not in those Texas properties. So these are the things that we learned during one of the biggest housing crashes in history, next to the Great Depression. This was, the Great Recession was the second biggest housing crash. And we got through it. We did not do so well on our California properties. We did terrible, and on some other things. I wrote about that in my book. But the Texas properties and the ones that we helped other people get into, these are the things we learned. The cash flow is king. You want to have enough cash flow to cover your expenses at a minimum. Or if you're getting a little cash flow, and don't get hung up on cash flow. I don't think, not today, because cash flow, hey, it might be $200 or $300 a month, right? If you're getting a loan, how's that really going to change your life? It's not going to change your life that much. The important thing is being able to have enough cash flow to cover all the costs, so that basically you've acquired an asset that's going to give you tax benefits. It's going to pay down a loan for you, that you're able to get a loan and someone pays that off for you. That in a time when also the value of the house is most likely going up if it's in the right location. So having enough cash flow to cover it is the key. Having a couple $100 cash flow, I don't know, is that really going to change your life? You might spend that in, a dinner somewhere. So to me, it's more of a long-term play. What are you really doing this for? And then cash reserves are vital. You want to make sure you can hold that property for the long term and have enough reserves in case your tenant loses their job, or they go through a divorce, they have some kind of illness, and you don't want to be a terrible landlord and make them leave in the middle of a sickness or something like that. So you want to have reserves on hand. I would say 6 to 12 months. And then don't over leverage. Don't get in a position. When I say over leverage, I really don't even care if you do 100% financing, like a BRRRR strategy, where you buy a property, it goes up in value, you do a refi, take everything, you put in it, take it out, and go reinvest it. I have no problem with leveraging to the hilt, as long as you have those cash reserves in place and as long as the cash flow covers the expenses. When I over leverage, to me, means you can't handle the payments. If you can't handle the payments, and you have to consider that there could be times when you don't have a tenant. The things happen to tenants. They can be in a volatile situation, especially at a time when the Federal Reserve is trying to slow down an economy and not have as many jobs available out there. So just make sure you've got plenty of reserves to cover any leverage that you take. And then just knowing that financing can disappear, so be very careful about short-term lending. This is any kind of bridge loans, fix and flips. Those types of things are more risky today, simply because financing can disappear, and I much prefer longer term, although 7-year ARMs and 10-year ARMs to me are still great. They're still great because a lot of times people refinance anyway within that time period to do the Burr method, like I said, to take out some of the equity and continue to invest. So if you want to have better rates, you might look at the 7 or 10-year ARMs, because you're still fixed for that amount of time, and there's a good chance you might be refinancing in that time. But getting into bridge loans or loans that balloon and you got to pay them off in a year or two, that to me is risky. Be careful about that. I have a lot of concerns about multifamily investors who are on bridge loans and may find themselves in big trouble. That could be an opportunity for buyers in the future. And of course, the right market matters. Like I said, we were buying at the peak of the market in 2006, but we were in Texas. We were not buying at the peak of the market in California or Florida or Arizona, where the bubble did come out of those markets at that time. So, being in the right markets where there's strong job growth, strong population growth, and not as much speculation can get you through changing times. And again, in 2013, I share this, and I'm sure many of you have already seen this, but it's important to understand that a lot of the headlines that we see, you need to look into it a little further and kind of find out what they're talking about. When I was asked to debate Robert Shiller of the Case-Shiller Index back in 2013, his position was that it was a dangerous time to buy real estate. My position was it was the best time ever to build wealth. I think we can all agree that I was right on that one. But he's a data guy, and he was looking at price declines during over the past 4 or 5 years. So if you just looked at data, you'd say, wow, people have lost a lot of money. But again, we were talking to investors, and we were seeing the cash flow, and we were looking at different metrics, which was the cash flow. The rents on properties were 2-3 times what the mortgage payment was at the time. So it just made so much sense for investors to get in. So again, be careful of the headlines, because you don't really know who they're speaking to. Are they speaking to the buyer or the seller or the investor, or, like who are they talking to? You've got to really study it a little bit further and interpret those headlines, which is what I've been trying to do since then over the years and through these housing updates. This slide, again, was shown at our live event, and so I snatched it from our lender there. You can go on our lender page to see who we recommend for lending, but you can see that housing generally stays pretty strong through recessions. So is there a chance that we will see a recession? Definitely, we probably will. But a recession technically means 2 consecutive quarters of negative GDP growth. And that's what the Fed's trying to do, really slow down this growth so we don't have so many jobs, so that we don't have such a frantic housing market, and that, rents will go down. That, this is the intention, is to slow things down. And will the Federal Reserve get it perfectly? Probably not. So we probably will see a recession, but it's not something you need to panic about if you're at least in the world that we're in, in the affordable housing world. Because if there's anything needed today, it's affordable housing. And that's what we specialized in at RealWealth for 20 years, is trying to provide that, trying to make sure that the average person in a market can afford the rent that we're offering. So you can, again, see from the slide that in past recessions, it might have a certain industry might have been affected, or the stock market might have been affected, but it wasn't necessarily translated to housing. The one time that there was a major exception, of course, was the housing recession, and that was strictly due to a credit bubble, a ridiculous, stupid credit bubble where, it was like, look under your chair, you got a mortgage, like free mortgages for everybody. You could have, and I was a mortgage broker, I knew the industry very well. You could have unlimited loans, investor loans with no money down and no verification of income or assets. So why wouldn't you? When I went to Dallas to buy those homes, I came home with 5 new homes, no money down. It was a beautiful time to be buying. It was so easy, but not everybody bought the right stuff, and they overpaid and they didn't have to put money down, and many had bad credit anyway, so it didn't really matter if they just walked away. That was a different scenario. But otherwise, a recession that is just a slowdown in GDP hasn't necessarily affected housing. It certainly didn't during the COVID recession. You can see it did the opposite. So where we are today is an affordability gap with home prices that have gone up so much, and now mortgage rates up. There's this period of time right now where the difference between owning and renting is really growing. There's fewer people that will be able to afford to own a home, and that means there will probably be more renters. I do see that changing over time because, like I said, I think we're going to see a slowdown in home price growth, and I do believe that we're going to see mortgage rates go back down as the economy slows. But in this period of time right now, when there's fear and people are scared and they think there's going to be a housing crash, this is really actually a pretty fantastic time to be building your portfolio when there's a little bit of fear in the air. And some of the areas that you could focus on are areas with high job growth. We know Austin has, and this is high income job growth, Austin has had the highest high income job growth and recovery. Dallas next, then Jacksonville. And I have some slides on Jacksonville because Jacksonville's kind of a newbie to this list. We've known that Austin and Dallas were hot on job growth, but Jacksonville and Tampa, Raleigh, we already knew that, but Atlanta, like some of the, Indianapolis, did you expect to see that? High income percent of or jobs recovered in the high income area. So there's a shift definitely happening. Salt Lake City, and these are no longer blue collar areas. These are white collar professional areas, and definitely things changing. So I said I'd talk about Jacksonville, and I think it's really interesting because when we started investing in Jacksonville through our awesome team there, it was really more of a blue collar area, and that's what I was teaching people. And we really started buying in 2009. But then we met the team that we have there in the early 2000s, and it was definitely not what it is today. It was, we were definitely buying, I would say, lower income working class housing. But look now, the biggest job growth in Jacksonville is in the professional and business services. That's incredible. So Jacksonville is not blue collar anymore at all. And I mean, there still is obviously all kinds of jobs. You've got trade and transportation and utilities. You've got a port there that's growing. Leisure and hospitality is back. Education and health services, financial activities. Again, these are high-paying jobs. So Jacksonville becoming a very diversified area with more high-paying jobs. And that's part of the reason why we're seeing such an increase in home prices, because all these professionals coming to Jacksonville and everything still looks really cheap to them. So this is a chart from Zonda that I think is incredibly interesting. I'm borrowing it from them. I'm borrowing all of these charts, but I let you know who gave them, so I'm allowed to do it. But this is really telling that if you've got people moving from Washington, D.C. or New York or Los Angeles to Jacksonville because of all these professional jobs that are moving there, back in 2020, it was 66% more affordable for people from Los Angeles who moved there, 51% for New Yorkers, and 47%. Well, prices have gone up, but look, if you're moving from LA to Jacksonville today, it's still 63% cheaper. So that's incredible. That's why it's not over yet in certain markets. In markets that are attracting these kind of high-paying jobs, we're probably going to see home price growth continue for a while because you just can't build fast enough. Believe me, ask our teams that are trying to build. It's not easy. The same true for Tampa and the outerline areas that we love so much. If you're moving from New York, it was 53% cheaper. Prices have gone up. It's 42% cheaper. Still a bargain. And Washington, D.C. and Chicago, moving to Tampa. So getting a little bit more expensive for people moving from Chicago, but not from Washington. Orlando, you can see that's still cheap for these people. That is what we're seeing. So who's migrating where? And these are the migration winners. You've got Cape Coral, number one. Look at that, from people moving in largest net domestic migration. Then Sarasota, Connecticut, that surprised me a little bit. Salt Lake, we love our project there. Boise, of course. Wish I'd kept my 3 homes in Boise. Oh my gosh, I can't imagine what they'd be worth today. Orlando, look at it's up there on the list. Lots of people moving to Orlando. Albany, Schenectady, that's where my mother-in-law lives, and I always knew that was going to be a hot market. Should have bought something there. Detroit on the comeback, love to see that. And Cleveland as well, and there's Jacksonville as well, taking all that new growth. The reason I put Jacksonville is it's a little bit cheaper than other areas in Florida. So an interesting thing about Jacksonville, and I think I forgot to put the slide in this, but I can give it to y'all later if you want it. But Jacksonville is a migration for Floridians. So you see a lot of people leaving the expensive Miami markets and kind of moving up to the Jacksonville area because it's cheaper and they might want to be near family but not want to have to pay so much. And then these are the net losers. New York, #1 on the list. Just so expensive there. But nonetheless, prices are still going up even though people are leaving. Same with San Jose and LA. So we still have home prices going up even though there's a out migration. You could see on there. All right. So coming back to Jacksonville, you know, in these growing metros, the best job markets are not the biggest anymore. So you see Austin, Nashville, Raleigh. This is a recent report that came out, you know, same things I just showed you, with Jacksonville #5 on this list of mid-sized metro areas, and with the hottest large city job markets in 2020. It's really these metros. It's really the metros that we've been interested in for so long. We wanted to be in metros that had at least 1 million people and that had job growth. And I guess the world's caught on to our little secret. Employment rank, you can see here again. Austin just keeps coming up. People kept asking me if we should buy in Austin. I just didn't see the cash flow there, so we didn't. But boy, oh boy, if you bought in Austin, look at that. Salt Lake, Dallas, Jacksonville, #4. Yeah, so this is why I love Jacksonville, because it's ranking, and yet, you know, prices are still great. And same with Tampa, Charlotte. If you're wondering again if there's going to be a crash, you got to look at retail sales going up. So people are spending money, and they've got a lot of money to spend. That on the right is the total savings deposits and money mutual funds. There's $5.8 trillion to spend. You know, so they're spending it, and that's going to continue to keep the economy booming even as the Fed tries to slow it down. So to give you an idea, I asked our teams what they had going on in Jacksonville, and they had this new home, I think is almost finished, for $359, and that is much, much higher than we've ever seen prices in Jacksonville. But this is close to a little bit more than the average price, but it's a new home. So not a great cash on cash return, but if you're going to buy in this area, you're really just looking to cover your expenses and go along for the ride in appreciation. And this is not something I like to say out loud to buy for appreciation, but that's what we've done all along. It's just like get into areas that you know are growing and get in at around the median home price so the average person can afford. Lock in that payment, and most likely you're going to see prices and rents increase because it's just so hard to get new supply. This Cape Coral duplex is another one that they said that this has a higher cash on cash return. This is actually a pretty phenomenal deal here. $550,000. If anybody's looking at that, definitely call your investment counselor at RealWealth to find out more, because I imagine this one will go very quickly. This might be the one. I just drove through the area last week when I was in Florida and got to see a bunch of these duplexes and go inside. And you know, if you're going to buy a home and it's a new home, your repair costs go down dramatically, and that really needs to be accounted for in your projections, that you're just not going to have to spend a lot of money on repairs. Most likely it's covered, and insurance tends to be a little bit lower on these newer homes as well. So make sure you add that in. This is an older home that's been renovated in Newport Richie, some of our investors got to see this one on the tour. This one has a little bit higher return on the cash flow, 274 with estimated rents at 2,000. I believe this is still available, although it was on the tour, so it may have sold. But again, if you're interested, be sure to either reach out to the Tampa team or the Jacksonville team to find out more about these. And finally, I wanted to address, I think, a misnomer that institutional funds are buying everything. There are 142 million housing units. 127 of them, million of them are owner occupied. Renter occupied, there's 44 million. And 20 million of those are professionally managed multifamily. But single family, there's 17 million units, and 500,000 of those are institutional. So there's this belief that, again, that the institutional Wall Street firms are taking over everything, but it's just not the case. So I wanted to point that out. It's concerning because they want more market share, and I think if they had it their way, they'd have all 17 million. They'd have it all. But I can tell you, we just met with all the property teams yesterday. We're doing weekly Zoom calls now, and our teams really want to help our members build wealth versus the Wall Street firms. So even though the Wall Street firms would buy everything they have, and we were all just at a conference with those Wall Street firms, and trust me, the teams that we work with were hounded by these institutional investors who will literally buy everything they have. But our teams have committed to present it to Real Wealth first, because they prefer to see individuals build their retirement, build their future, and be able to get in the game. So we're very, very grateful for that. Okay, so now I can take questions, and I'll come back on camera. Hey there. All right, any new syndications? We do have 3 coming up, and I can't talk about that because I don't know who's on all here, although we're probably going to file it as a 506C, in which case I could talk about it, but I don't know for sure yet. So if you haven't already filled out the form to find out about our upcoming syndications, do that right away when you go to log in. Boy, I know that when you join as a new member, you do that. And now I'm really not sure. If somebody from our team can just text me and tell me how somebody will fill out the accredited investor form, that will get you on the list to find out about our upcoming syndications, but we do have 3 coming. Given an increase in building costs and home price increases, how should cash flow minded real estate investors shift strategies in this environment when a lot of opportunities are negative cash flow? Yeah, it's a challenging time because exactly that. Mortgage rates have gone up and home prices have gone up, and the cash flow is not what it was. We do have some teams who still have high cash flow, but you're going to be in markets that aren't growing as fast. So if you're looking for cash flow, if you're at a point in your life where you're really living off the investment and cash flow is really important to you, I would make sure that you talk to our teams in Ohio and Indianapolis and Birmingham. These are areas where you can still get decent cash flow, especially Ohio. But if you are looking to build wealth over time, I would really just not worry so much about the cash flow and look more at what's happening in certain markets. What we learned over the last 2 years is that there are certain areas that were very pro-business, and there were certain areas that weren't. For example, in Los Angeles, if you wanted to, it was very frustrating. There was a restaurant owner who had their restaurant closed, but then right next door, there was an open restaurant for the employees of the film industry. So it made no sense, and it wasn't fair. Why could this one be open and the other one not? And if you tried to just open illegally, they would just turn off your water and your electricity. So, a lot of states learned, or a lot of businesses learned where they can do business, and businesses like to do business. So I'll let you answer where you think where those states are. but it became really, really clear over the last 2 years, and many businesses are moving to those areas. Even businesses that were in areas like New York and San Francisco that are highly liberal areas are moving to very conservative states. And that's again why we're seeing some of these high paid jobs moving to more business friendly areas. That might have sounded political. It was. All right. Modern monetary theory. Yeah, it's someone said, thanks for bringing that in. We're just in a different world. This isn't, you can't plan, you can't forecast the way that you ever would in the past. It just all depends on the Federal Reserve. And again, the Federal Reserve is a banking system. It's the biggest banks in the US. So you've got to ask yourself, do the biggest banks in the US want to see a massive recession? Do they want to see tons of foreclosures? That didn't work out well for them last time, right? It was so awesome in 2009 if you were buying foreclosures, but it was very quick that the banks learned they didn't want to give their assets away like that. And they changed the way they did business. They did loan modifications. They let people just sit in the house. They learned how to fix and flip. I mean, banks aren't going to go through that again. So you might wish for it. It's not going to happen. I don't think. I think the banks are really in the business of supporting the asset classes that they're in, which is housing and the stock market. Again, that's just my personal opinion, but that's what we're seeing worldwide is an addiction to this modern monetary theory, which is just keep printing money to solve problems. And that generally creates inflation, which creates a bigger divide before the haves and have-nots. It's my passion to get more people to own their first home, however you can do it, however you can do it. You know, if you're a parent and you have children and none of you own homes, do it together. You know, just do whatever you can. If you've got kids going to school and they have roommates, buy a house and have each kid rent a room. You know, it's going to be more and more important to own assets because you will be like the way I described it is like you're on an iceberg and you got the people who own real estate that are on the iceberg and floating away from those who are just trying to, swim towards it. And it's very sad, but it is the world we live in. Yes, we do have population slowdown and growth. We have a percentage slowdown in population growth, but the population is still growing. Okay, so a question is, the Fed is saying that they're going to sell off their mortgage-backed securities. That's one of the ways that they kept rates mortgage rates so low, is they were buying them. There is an assumption that that outside investors will be buying those because it's one of the better returns that they're going to see out there, a flight to safety. So again, that is why some of the economists I listen to think that rates will go down over time. So if I believe the Fed is near an end of increasing rates, you must believe inflation is going to rage. No, I think the Fed is going to continue to raise rates this year. That's the plan. They have to. And the intent is to slow down the economy, in which case I believe they'll succeed. And as they raise rates, it'll slow down the economy, which then they'll have to lower rates again at some point, which is what happened in 2018. It went up to about 2.5% of the overnight lending rate and then reversed it. So we're only at 0.75. So I think they're going to go up to that, 2.5. I think they're going to get up to where they were in 2018 to 2.5, which technically would have mortgage rates around where they are right today. That's why I think that personally, I think that the banking industry sort of adjusted already for what the Fed said they're going to do. That's my belief. I don't believe that inflation is going to rage out of control because the Fed is going to go after it and slow it down. So I do think actually inflation is going to get under control, and I think we might have already hit the peak of it. Someone asked about the IMN conference I was just at. It was a conference with the biggest hedge funds in the country that come together to talk about what they're doing. And All of these funds, they see a recession coming, but a very brief one. They don't think it's going to affect housing, and they are buying as much as they can. So if that kind of tells you what these firms are doing that have access to a lot more data and information than we have, they're really trying to they see single family as a mom and pop, unorganized asset class that they would like to take over. What are your thoughts about the housing market in Sacramento? You know, I'm not an expert in the Sacramento market. I know prices have gone up dramatically, but yeah, so I really can't speak to that. But I know people if you want a referral to somebody in that market. With current huge housing prices, which are the states providing good opportunity? I think I went over that. How do I get started? Very good question. If you have joined RealWealth, you go to realwealth.com and join. You'll be able to pick an investment counselor. And we have investment counselors that are the real deal. Oh my gosh, they buy from our teams. They are building their portfolios. Some of them have more properties than Rich and I at this point. They're really active, and they are so passionate about helping our members build wealth. It's so amazing. So take the time to speak with one of our investment counselors that care so much about you, and they'll kind of find out what your situation is and what might be the best market for you. Okay, someone asked about which neighborhoods in Jacksonville. I am not the Jacksonville expert, but we've got one. So, you know, just if you've already joined, you'll be able to have access to that Jacksonville market. If not, be sure to talk to an investment counselor so they can unlock all of the markets for you on our website. And we kind of keep it limited because we don't want our teams to be overwhelmed, so we don't make their information easy to find. There's 70,000 of you and just 15 of them. So we really want most of your questions to come to us, so that when you're really ready to buy, you go to them to get the details, but talk to one of our investment counselors first. What do I think of short-term rentals? Rich and I started that during the pandemic, and during the pandemic, it was unbelievable. We were in shock at how much money you could make, but that also was part of the fact that people couldn't fly anywhere or go anywhere, so they were just kind of driving, and we're near LA, so that's 10 million people that were looking for an Airbnb. So it was very, very, very lucrative over the past 2 years. People are eager to get out and fly again. So there could be, we're starting to see a little tiny bit of a slowdown, but I still think the short-term rental business is great if you're well located. You've got to be really, really careful about regulations. I know in LA County, it's really strict. You have to live there and you have to be there. So it has to be like a guest room or a guest house or ADU or something like that. So just make sure you really understand the local laws, and that you have multiple exit strategies, that maybe the property would work fine for a 30-day rental or a long-term rental if if the rules change. And also the taxes are very different on short-term rental. You're getting taxed differently than long-term. So long-term is always better for that reason, and less of your time. It's definitely more of a passive thing. But if you buy the right short-term rental, it can be pretty fantastic. And I know that our Jacksonville team has a few of those, and they manage them for you. So definitely talk to them if you're interested. They've done really well. Average monthly management expenses for out-of-state rental. If you're talking about property management, it just ranges from 8 to 10%. We try some are even lower. But again, talk to your investment counselor or go online and you'll see the different pro formas to see what the different companies charge. Someone said, do you know if the big institutional investors have a long-term view for buying single-family rentals? Yes, that's what I'm seeing, that they're really creating a business. Back in the day when my dad was an investor, multifamily was kind of a mom and pop thing too, and then the institutionals came in and really, really got busy on multifamily. And now they're looking at single family as an opportunity. So I believe it is their intention to continue to grow and their share of the single family rental market for long term. There was a lot of talk about them dumping it, but what are they going to dump it for? They're seeing a lack of supply, massive demand. Yeah, I don't think any institutional investors planning on dumping their assets at this time. Can a 1031 exchange join your upcoming syndication? No, I'm so sorry. It has to be a Delaware statutory trust. But if you have a 1031, we do have more inventory. As interest rates go up, we're starting to see a little bit more inventory. Nothing that is going to cause any kind of housing crash, just a little bit more inventory, which is incredibly good for the market. So we're starting to see more. Our teams have more. So if you have a 1031, I know that our Tampa team has some product ready. Jacksonville has a few ready right now. Who else said? Oh, Dallas has properties available. And then we have lots available in our Park City project that I just still think are an incredible opportunity. They don't cash flow, but if you're willing to either hold a lot or go through the process of getting it built, I personally think you would make as much money. I think you double your money. That's my thoughts on that. If you want to know more about those Park City lots for 1031, let me know. What's my advice for someone who wants to invest in real estate but is fearful? I understand. The first, it's terrifying. I had when I first started, I didn't understand any of it, but getting your first rental is the most important first step. I would say talking to a lender to understand what you can qualify for is a really important step because that helps you see, what you can qualify for. Next is to really study, read my book, Retire Rich with Rentals. That will give you a lot of background. Listen to the webinars at RealWealth, and maybe talk to some of the other investors at RealWealth. Our investment counselors are investors. They can give you their personal experience. But just keep taking steps forward. The more you educate yourself, the less scary it is. But trust me, even your first rental is going to be terrifying, but you're going to learn a lot in the process. And it may not be the best deal in the world, but you will have learned so much and you'll check off all the boxes of what you needed to learn in that process. And I can tell you that over 20 years that RealWealth has been around, we've really weeded out people from our referral list that weren't meeting our expectations. So the people who remain on our referral list, they have over 10 years of experience with our investors and track record and awesome reviews. And when things don't go as planned, because it's real estate and not everything goes by the pro forma, right? You can't control tenants, you can't control the market, but that these teams are really there to do the right thing. So working through our group, I think, is a really great way to get started. Let's see. I think I talked about business friendly, but Texas and Florida were the two areas that were really pretty strong in terms of keeping businesses open. That's why so many businesses continue to move to those areas. Okay, Leah said that to get info about our future syndications and to complete the accreditation verification form, members can go to developments.realwealth.com. Yay! I love that my team knows more than me. Developments.realwealth.com. Find out about future syndications. You have to fill out the form. It's a SEC requirement. We have to know you and know your financial situation. It's a requirement. It's very different than Department of Real Estate law. Can you compare owning real estate versus investing in precious metals? Yes. Precious metals don't cash flow and you can't leverage, and they're really more of a backup security sort of protection of your wealth versus a wealth builder. So if you have $1 million and you don't want to lose it, you might have 10% in gold. Just because if everything falls apart, you have gold. But it doesn't make you money. It doesn't cash flow. I would much rather own an asset. I like hard assets, but I'd rather have one that people can use. Sure, you can wear your gold, but why not have a house that has the same kind of idea, but you can rent it out and get all the benefits, tax benefits, and appreciation and, you know, loan payoff, pay down by your tenant. I mean, there's just so many benefits to owning real estate versus gold, in my opinion. But I still think it's good to have a little bit, just in case the whole market crashes in terms of like, I mean, like the dollar. If the dollar crashed, you'd want to have that gold, but that's not going to probably happen for a while. What's going to happen for a while is just creating more of those dollars. Do you ever see California turning around and being a more investor-friendly state? Boy, I don't know. You'd have to put something in the water, I think. All right. I bought Sacramento in 2020. Zillow estimates I've made about 100K in equity. Yeah. Yeah, if you can make the numbers work in Sacramento, I think there's still an upside there. What do you think about the Cleveland, Ohio area? We have a team right now that's our investment counselor is there right now interviewing a new team in Cleveland. So we do like Cleveland. Do you have to fill out the form if you're already a RealWealth? Nope, you don't have to fill out the form. If you've already been in a syndication or have access, we already have your information. A friend of mine referred your company to me. I noticed his referral list is different. Oh, okay. Yeah, so we have investment counselors who will unlock different parts of our website for you. So if you're not seeing all of our markets, it's because that's not open to you yet. And again, that was kind of a way for us to slow down the flow of referral leads to these teams. We don't want them to get overwhelmed. But if there's a team that you really want information on, just talk to the investment counselor and they will open that for you. Okay? Oh my gosh, I got through all the questions. Oh, one more. If I have 5 to 6 cash flowing properties and I leave my W-2 job, how hard will it be to get mortgage on additional properties? Keep your job while you're still buying. I see people do that. They quit their job. You need to show enough income from your properties and over a long period of time in order for that to really qualify. So if you're planning on buying more properties, just keep your job for a little while longer or find a new job that you like better. All right, everyone, thank you so much for joining me here for our mid-year housing update. We are here to answer your questions anytime. If you like this format, one of the things that I was thinking about doing was just doing regular Q&A webinars just to, you know, answer your questions on a regular basis. And if that's something you want, please let us know because I think we're happy to do it. All right. So take care and I'll talk to you soon. Bye-bye.